overall, I think it matters, but I think it matters less than current market participants generally pay to it. I've been arguing that the fiscal situation is generally a much larger impact on markets than the Fed at the moment. So, for example, if the Fed were to come out and just cut rates to zero, then of course that would be very impactful for markets. But around the margins, when they go forward with their likely plan of 25 basis points cut here, 25 basis point cuts here. I've generally argued that the economy in the US is relatively rate insensitive to those types of small cuts in a similar way that it was rate insensitive on the upswing in rates more than most people expected. And that's because this will likely be the first time we have a higher low in interest rates. So we had 40 years of lower lows and lower highs in terms of interest rates, both short-term and long-term rates, including things like mortgages. This is the first cycle we've had a higher high in interest rates. And when they do go ahead and cut rates, it's unlikely we're going to get back to zero, just because there's more kind of structural inflationary components of the system. And so I think that we're going to get less of a refinancing wave than we've gotten in prior rate cutting cycles. And there's a lot of companies and a lot of individuals that have locked in long fixed rate debt at much lower rates than current rates. And then importantly, much lower rates than even they're likely to cut to anytime in the next six months or more. And so I think that the cutting cycle will be relatively uneventful, at least in the early stages of it, because only around the margins does it actually impact borrowers in the economy. I think it's telling us a handful of things. There's the geopolitical element, which is that more central banks are deciding to increase their gold allocation relative to treasury allocation. Some of this is because they now recognize treasuries as a confiscatable asset potentially. So there's a component there. And then the other main components are the other structural one would be the idea that most developed markets have so much public debt, and it's relatively unpayable in any sort of real purchasing power terms. And so holding the sovereign debt of other countries is not a particularly attractive long-term proposition anymore. And so gold becomes more structurally interesting in that sense, both for individuals and central banks. And then in the nearer term, the fact that the rate cuts are likely behind us. We look forward, basically the market's forward looking to at least some mild or moderate path of rate cuts. And all else being equal, real rates are very impactful for gold. If anything, gold has held up really well considering how high real rates have been over the past 2 years. And I would argue that's because of the ongoing fiscal dominance, the ongoing central bank accumulation, and the big headwind against it, along all those tailwinds, was that high real rate component. And so if you finally start to alleviate that final headwind against gold, that allows it to rip. And of course, markets are forward looking. They're kind of positioning ahead of rate cuts. For years, we kind of saw gold break out in most currencies other than the dollar. And now we're just kind of finally seeing it also break out in the dollar, which I think is structurally important. The fact that it's already weakened against gold is telling. I do think that there's probably a lot to learn from the 2002 to 2007 cycle in markets, which is when, the U.S. went through a mild recession. They cut interest rates. Going into that period, the dollar index was very strong relative to other currencies, and they ended up, cutting interest rates. That gave breathing room to a lot of other currencies and emerging markets that have a lot of dollar-denominated debt, and that really helped set the stage for a pretty big gold bull run that occurred all throughout the 2000s decade, and then even extending. Emerging markets kind of started peaking out 2007 or so. Gold, of course, had a bigger run for a number of more years, and so I do think it's telling us that while the dollar has been strong relative to other currencies, it's still weakening relative to other scarce assets. And the dollar index itself could be taking a bit of a breather here after such a strong period. And if you look around the world, gold is still the biggest monetary base. So some countries like the United States or China have bigger broad money supplies than the estimated amount of gold that exists. But in terms of the actual monetary base, gold is the biggest one still. And as a reserve asset, central banks can hold it without worrying about confiscation. When you look at the long-term supply characteristics of gold versus fiat currencies, most developed market fiat currencies grow in supply by 6 to 9% per year on average. Obviously, during the pandemic stimulus, it was higher, and currently it's lower because central banks have been trying to kind of slow that down for a period of time to control inflation. But the long-term structural average is 6 to 9% per year, whereas the long-term gold growth average is something like 1.5% per year based on most estimates. There's a lot of stock already accumulated, and it's mining it is a very energy intensive process. And even when the price goes up, we generally don't see very fast response functions for how much more gold comes out of the ground, because the permitting and the mining is a very long-term process. And so basically they're just recognizing it as overall a better currency than all the fiat currencies that exist. So I think we've already, gold has chopped around in a range for quite a while. That was a really long accumulation period where it broke out in 2019 and 2020. But then once things started to slow down, gold went through a consolidation for a considerable amount of time. I think that was the accumulation zone. I don't try to predict near-term markets too much. So it's quite possible that gold could have a correction here. But I think that it already went through that period of kind of having a long period of not really fireworks happening. And I think this breakout probably has a lot of legs to it. I wouldn't really expect as a base case for it to go back down to 2000 or 2100 or so. Could it correct $100 or $200? Sure. But I think that, when you look forward over the next 5 or 10 years, I think the upside of gold is significant. And I think there's a risk of waiting for, minor pullbacks and then not establishing the position that you might otherwise have wanted to do. So I think that someone can layer into a position here so that if they, if we don't get a pullback, at least they've started their position. Right. And if we do get a pullback, then the next layer of capital they put in, they could accumulate on the next, correction. Generally speaking, it should follow gold with higher volatility. I think that if a bull market really gets exciting, right now it's still kind of a quiet bull market. You don't really see major financial news, clamoring over gold in a similar way that you saw. Yeah, not at all, right? So back, for people that were around in 2010, 2011, 2012, that was a very kind of, gold was hitting like mainstream media on a regular basis. It was kind of a mania. And this is still kind of an early stage breakout of a long consolidation. And so I'm not surprised that we don't really see other metals rallying to a significant degree. I think a lot of this is central bank purchases, and a lot of this is Asian private sector purchases. We don't really see the mania in North America yet. And so if we do get that kind of mania phase, I could see silver having a really strong run. But overall, I think gold's an attractive risk reward because that's what central banks are buying. They're not really buying silver. Silver's more of a retail metal. So I think that, the stock market, despite the corrections recently, has done, very well this year, right? So if gold was going up and other things were not, then maybe gold would get more attention. But the fact that gold is one of many things that have done well this year, it's just kind of lost in the noise, I think. The breakout's basically not big enough or interesting enough to them yet. I think it's kind of the early stage where, and that's good. That means that the bull market probably has legs to it. If the mainstream media was already all over it and people were already kind of focusing on it, that might indicate that it's later in the bull market. Whereas the fact that it's not really getting attention yet, I think indicates that it's still early. It's just not, it's not a particularly noteworthy number yet. The 2,500 level is psychologically interesting. The fact that it's got a, brand new kind of, number in front of it is attractive. But it's not a particularly remarkable number compared to the length of time it's spent chopping around 2,000. And so I think it would have to get probably much higher before it would really catch the attention of a lot of mainstream investors and institutions.